Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Good evening, and thank you so much to all the attendees who joined into this broadcast this Friday evening. My guest this Friday is Mr. Bharat Shah. He's the executive director of the ASK Group. He's been with them for over 2 decades and has been on the board for a little over a decade as well. Mr. Shah has had a very, very exemplary career behind him. In fact, he's trained some very successful fund managers and CIOs in the mutual fund industry. As on today, some still consider him their guru. He's been a rank holder, chartered accountant. He's from IIM Calcutta. He was topper of his batch in finance. Interestingly, started his career with Asian Paints and is also the author of many articles, speaks extensively at universities in India and abroad, and is also an author of a book which he has written not too long back. Don't go by his age. I can tell you by interacting with him or what he looks like. His enthusiasm for stocks is as much as it would be for a 25-year-old, and he gets into as much detail as a novice would getting into the market. And it's always fascinating to listen to his point of view, especially when he plays devil's advocate on any stock that we pitch to him as sell-side analysts. So, Bharat Bhai, so much for taking time out to do this. It's a pleasure speaking to you on
Pleasure.
this forum. Uh, I want to just start off by asking all my guests, I hope everything is safe at home, at work, everything is all right.
Yes, yes, everything is perfect. Thank you.
Excellent. So, Bharat Bhai, there would be a lot of people who would have joined into this broadcast who would be either at the start of their career or people who you would have trained and would have joined in to hear the veteran that you are. I want to take you back to the start of your journey. And I read somewhere that, it started off by you buying annual reports with scholarship money, and you would just build your own library of annual reports and go on reading them. Uh, from CA to IIM to coming into the markets, talk to us a little bit about the early part of your journey and how you fell in love with and how you started romancing the stock markets.
Uh, well, I think well before I did my studies right in the college, somehow investing seemed to draw me in. And I don't know how and why, but it seemed to cast a kind of a spell. And unconsciously and then consciously, I got drawn towards it. So, which is how I think the love affair began. Uh, I sought to supplement, in general, I'm a voracious reader. Uh, so, I took up to kind of reading about markets, about investing. The literature at that point of time would be available only in the Western world because investing literature really has not been much in India side even today. And to that extent, the milieu and the examples probably may be very alien and different. But the methods, the principles, the philosophy, the approach, the ideas, I think, sorry, that appealed a great deal. The then the journey into starting my chartered accountancy. Along with that, I did my cost accounting, and finishing that, I joined into MBA program at IIM. So all along, that fascination remained. So you may call it as a hobby or whatever, but it occupied a lot of my time also that. And I spent initial part of my career into the non-investing world. So as you correctly mentioned, I started with Asian Paints, but at every point of time, my job at Asian Paints required me to travel a lot. Then I worked for Glow Plus, which was the largest luggage and toy maker in the country at that point of time. And both these stints required me to travel a lot of bit. And wherever I used to travel, I on my own took up some opportunity to meet with some person in the companies which might be located at that particular place. So that's how my kind of a research on my own began in a more formal way. Of course, I supplemented with purchasing from the newspaper vendor the annual reports because I could hardly have afforded buying stocks. Coming from the middle class background, the first priority is to make the living and to pay for your existence. So investing in practice was luxury I couldn't afford at that point of time. But the at some stage I felt within very strongly that time has come to do something more intimate and more direct. Uh, I was, with God's grace, doing very well in the work at that point of time. In fact, in the firm, I was given chairman's gold medal as the best employee of the year. And as it would be, just a month after that, I decided to quit. And they were shocked and taken aback as to what was this foolishness that I was up to,
Mhm.
leaving something which was a good work, where I was recognized, and where I had a good career path ahead. My family also felt the same way. They thought that I was all this time what was an indulgence or a hobby was threatening to be more serious thing, and they felt that I was being carried away. Except my wife, nobody really supported that decision. But she stood firmly behind, saying that if you've thought about it and if you feel so much about it, it must be right. So go for it and don't worry. And that is where the first step began, where I applied. And as luck would have it, I got the work. And that's how the career began in the year of in 1989.
Interesting. Bharat, there was a period where you were working for a research firm that had shut down and you were without a job for a few months subsequently. How did you deal with that period? And sort of, did it involve doing more research? Did you ever second guess the profession you were about to get into or question the journey you were about to undertake?
That reminds me of the Charles Dickens' famous book, and it began A Tale of Two Cities. It was
Mhm.
best of the times, and it was the worst of the times. So the work that you are referring to happened at Gromor Research
Right.
and Tech Management Limited. That was the firm which was run by legendary Harshad Mehta, Harshad Bhai, and his brother Ashwin Bhai Mehta. Uh, Without any doubt, I can say that is a place where I really learned my investing, or in terms of the basic foundation laying, Uh, more than learning the craft in its entirety, more than learning a lot of facts, it was the passion. It was the intensity of affair is how the investing has to be treated. That is something I kind of immediately took to when I saw the fire in the uh, with which Harshad Bhai approached his investing. And that is how Ashwin Bhai, very analytical, very methodical, very brilliant mind in terms of investment thinking. So the two represented a kind of an unbeatable combination. Harshad Bhai a staggering amount of resoluteness and courage in terms of backing what he thought and believed to be. And Ashwin Bhai represented very sober, sharp, and razor sharp kind of a mind and analytical capability. So while I worked with Ashwin Bhai very closely on a day-to-day basis, but I really enjoyed that period because every moment, every hour was a learning experience. So much so that not just 6 days, I worked 7 days during that period. I used to work even on Sunday, and it used to be like a half day because I will reach office at about 10 and leave office by 5:30. So that was like a half day, some concession at the end of the week. So it was a great joy. I have nothing but really, really fond memories. It's not a matter of what happened to the firm, and even more regretful what happened to those individuals. But my affection, my uh, genuine from the bottom of heart regard and respect and love uh, for the firm and the people remains undiminished till date. Uh, the firm folded up. It gave a grind to me because it gave a chance to people, those who were naysayers when I made a decision to move into investing, that look what we told you so, you know. And it was very difficult because I could hardly defend what happened for no real fault of mine. But it was difficult period, very, very difficult period because I was without job. I was fairly senior individual in that firm, even though I was kind of a neophyte in the world of investing. But I was heading the research at the firm, and I had a team of 23 research analysts in that time, some 30 years back. So it was a very seriously strong research outfit. And therefore, in many ways, I was kind of untouchable to the lot of people in the industry. So nobody would give me a job. Markets had been in turmoil, and that was not a period when even foreigners had come into India. That happened later, just a little later. And the future looked very bleak and dark because I had virtually no funds to fall back upon. My career had just begun, and what I regarded as my most intense work and occupation, suddenly I was in a state of trauma. And a lot of thoughts came to the mind. I was a young father at that point of I had to deal with all of those situations. And without resources and without clarity about the future, it looked kind of a dark, long period ahead. I was out of work almost for a year. As it would happen, while that was going on, I became a victim of Bombay bomb blast that occurred in March 93. So I was caught up into that. So it was like a dark, long winter of a period of almost about a year. But as all winters have to end and springs have to come, finally I think the good things happen. And but I have nothing but love and affection for the firm, for the two individuals who really showed a lot of faith and love for me. And for the whatever happened to the firm was unfortunate and quite agonizing. And for whatever reasons that were at the background, but I still would say, despite all the difficulties that I went through subsequently, and all the challenges that those posed. I still would say that was one of the best of the times in terms of getting initiated. It was a baptism by fire, if you describe.
How would you say your investing style has changed over the years, Bharat bhai? Or has it just been more of the same thing and you've gone deeper and deeper into the same methodology?
Uh, very interesting and introspective question. In some core essence, I would say it is largely remained the same, but in some very important aspects, it is differed and improved and strengthened over a period of time. So right at the beginning, some core aspects I think fundamentally were there. My preference was always to look for quality management. The preference also was to look for quality businesses. My understanding of what a quality of management may represent at that point of time, or my understanding about what a quality of the business is all about at that point of time may not have been fully grounded and refined and polished. But as a core idea, the fact that quality of management and the quality of business are vital were very much there as a foundational stones. The other idea that has been critical and important right from the beginning has been the power of the growth. Ultimately, investment fortress or an investment monument is built on two very vital ideas. To impart it a strength and stature, and to protect it with a moat. The strength and the stature really comes from the earnings growth, because it is the growth of the business, the growth of the earnings, or rather the cash flows, which really provides the strength and the solidity and ambitious rising up in the sky to that fortress. The protective armor really comes from the moat, and moat essentially many tangible but lot of intangible, many visible but lot of to be deciphered kind of ideas. That gives it a protective armor that protects it from the vicissitudes of the business, vicissitudes of the market cycles. It protects it from the challenges of the competition. It gives it a relevance to the people whom these businesses serve, which is the customers and the employees. And it is a business, even through those challenges, retains a capability to price its products and services in an appropriate way, so that it continues to create economics superior to what forces want it to be reduced to. External forces always want to grind businesses to dust. It is the protective moat and the character of the business which allows it to fight, and not only fight and survive, but actually thrive and grow. That protective moat comes from the character of the business, the capital efficiency. So these ideas fundamentally have been always ingrained. I would say three things where from immature understanding, kind of a tyro kind or a neophyte kind of level of maturity in understanding some of these aspects, over a period of time, some level of improvement has occurred. And these three, I would say, one is basically ability to value businesses better. Second, very importantly, to develop a psychology and the temperament, the character and tranquility of the mind to deal with the violence of the markets, to accept the inevitability of the market cycles and its behavior, occasionally exuberant, often manic depressive, but be it as it may, to deal with it and to carve out your path without getting consumed by the violence and the machinations of the market. And the third part, I would say, basically, I would say my buy discipline generally from the beginning was good. By and large, I bought right things, and by and large, I bought them at sensible prices. But my self capability and the self discipline and kind of a formal structure around it to give me strength to ride above emotionality. I think that is a third aspect where improvement has occurred over a period of time. So, valuation is something I would say has refined and improved over a period of time from the inanity and simplicity of price earning multiple to arrive at a more cogent art and science of valuing the business, understanding that there is a mathematical part, but there is a very significant intangible art part, and to make a very fine eclectic blend of the two to arrive a cogent, sustaining, and empirically tested kind of an approach on valuation. That I think has significantly evolved over a period of time. So from the days of the 90s, I think in the early part of the last 2000 to 2010 decade, it became a lot better. And I would say from the day to last decade of 2010 to 2019, I think it is further definitely improved. And in some sense, I think the rude shock of 2008-9 of the crash all over the world very sharply and pungently reminded me to be sharper about my valuation methodology and approach. So that's one. Second, far more important than the first one, or far more important than any other aspect, I would say, is the temperament. Ultimately, markets are designed to make you fail. Markets have no real reason to make any investor succeed. Markets, by its chance, by its entrapments, by the temporary truths and the illusory shadows that it creates, is constantly trying to snare you in and to make you fall. It is for you to ride above it. It is for you to recognize that that is the essential character of the markets. That markets are what they are, and you have to accept the reality of markets as they are rather than judging them or trying to opinionate on them, but to really create your own designs, your mental makeup, your ability to understand the nature of the market, ability to carve out a path through the booby traps that markets are putting in your path, to temperamentally accept that time to time markets will be violent and there is nothing that you can do about it, and therefore not to get consumed by regret and not to get consumed by exuberance of the high of the market, and to remain in a kind of a detached mode. You remain an observer, but you remain in a detached mode that that is the way markets will, but you have to find your path. And actually, when you do that, markets actually are helping you, because time to time, by that behavior, markets help you by throwing opportunities your way. And therefore, volatility and violence of the market is not a threat, but it is actually an opportunity. Strengthening that firmament within and to strengthen the mind within has been a long-term process. And even today, it is still a work in progress. I mean, everything in investing remains a work in progress till the time you hang your shoes or till you time you bid an adieu to the world. Uh, so forever you are learning. But I would say this is something that you want to deal with every time. And every time, with every up and down, you want to strengthen your mind, and you want to remind you that this kind of picture you've seen before, you've seen what it results into, and you also know what are the precautions in order to benefit out of that situation, and not to become a victim of the markets, but to become a benefactor out of the markets. So I think it is still a work in progress, but I would say, if there is one aspect which is most important, and one aspect where I would say probably on a relative basis, I might have made a maximum improvement within me among various other aspects. You still remain a student and a learner, but maximum improvement if I made in one aspect, it is, I would say, in that. The third aspect, relatively simpler. When you have dealt with the first two well, the third becomes a kind of a byproduct of it. And over a period of time, my self-discipline and self-methodology and making it little bit more scientific and more definitive has become better. I still would say it remains a weakness. It's not a major strength that I can claim, but on a relative basis, it has become much, much better. Therefore, developing a sale capability, uh, ability to value businesses more effectively, and most importantly, strengthening the mind and temperament, the character within. I would say these are the areas where progressively at every stage there have been significant changes and improvements compared to what they were at different stages in the past.
Let me combine two facets of your previous answer into one question. One is, you said, you read a lot, and I want to, I believe you've read Fisher and Graham both. Uh,
Yeah.
Graham talks about value, Fisher talks about quality. And I think you have been fairly public in saying that price to earnings and price to book are not the absolute right way to value a stock. Now, when the entire market is obsessed with these two valuation multiples, and sitting where we are in 2020 and looking where the markets are, and people are now starting to discount FY23 earnings and so on and so forth. There's not too many places where you are getting good value. People say that if a stock is at a low PE, it must be at a low PE for a particular reason. It could be a value trap. So how do you marry this concept of not looking purely at PE or price to book, and yet finding the right, sort of mixture of what Graham says in terms of value and Fisher says in terms of quality?
Sure. Now, again, a complex question with many layers, like your typical questions are. So I'll try my level best to answer that question in multiple points. Mm, and a very interesting question, because I think as students of investing, all of us grapple with these issues all the time. Graham was a legendary and outstanding investor, a kind not too often world creates, and therefore he represented a certain school of thought, but an outstanding level of intellect, an outstanding level of definitive structure, it, definitive structure building around that thought in order to give it a shape. And he was a hugely disciplined individual in terms of doing what he believed in. So these are formidable traits to have for any investor. I mean, uh, some of the notions may or may not hold exactly the same relevance, but the fundamental underlying bedrock of ideas and kind of pillar laying that he did is unmatched in many, many ways. But we must remember that his investing was significantly shaped by the events prior to, leading to, and after the Great Depression. So Graham, in many ways, shaped these investing, refined these thoughts, and strengthened these ideas during events before, while, and after the Great Depression. Now, the period prior to Great Depression was a period of an unchecked exuberance. And even just before the crash began, there were many laudatory ideas circulating in the market about how good and great things are and how much more there was a room for markets to rise. Nothing unusual, because we have seen all the time that sentiments is a creature shaped and perfected by the markets and planted in the minds of the individuals. Therefore, in many ways, the value was abundant, and there was hardly any growth to be talked about, because there was no possibility to talk about growth while 4.5 years of Great Depression raged, and a whole generation thereafter forgot about investing itself, because they were so scarred in the minds that they couldn't have thought about investing. Having seen the 89% drop in Dow Jones over a period of 4.5 years, even a die-hard investor would have lost all the hopes. So in many ways, investing is an accident. If you happen to be born at a wrong point of time, however good you may be, but your investing may not have the same results. And we all have to be recognizant that many of the things that we do, many of the records that we build, there is a level of chance, and it is not entirely our capability or our strengths. However much we may think is all our strengths and capability, and in many ways, investing is not a game of chance. It is largely a game of skills, but there is a level of chance, and there is a level of a kind of a historical accident. So if somebody's investment career began to get shaped at the beginning of in the late 1910s or early 1920s, and then bulk of it went through till about 50s, then that record might have lived through a very horrid period where really you had very, very difficult chance to outshine and create something of an outstanding variety. But Graham had cigar butts all around. That's how his cigar butt investing came about, because there was so much of value. Virtually everything was available for $1 at 30 cents, 20 cents, 10 cents, 5 cents. And to that extent, value had to be a predominant idea because growth was hardly to be found, and the quality was not even required for you to work upon, because if you find something for 5 cents to $1, whether it is qualitatively good or otherwise, really was not a primary consideration, because you had a 10 bagger and a 20 bagger simply by purchasing an opportunity and having a mind of steel to ride through a long enough period so that that value will eventually assert. Therefore, whether you bothered about growth or not, whether you bothered about value quality or not, you merely had to buy because value was all over. The blood was all over for a long period of time. So I think Graham, his life, his investing, his career materially was shaped around those decades. And to that extent, those were the prevalent dominant thoughts. In many ways, Buffett's investing was hugely influenced by Graham more than anybody else's for a length of time till he realized and he came across Fisher's thinking until he also began to make some mistakes in his investing in that period, where slowly alternative ideas of the quality, alternative ideas of growth, and those were the two principal ideas that Fisher contributed. Quality first and foremost, founded and supported by growth. And this then later on, Buffett became more and more Fisherian in his approach and thinking, and relatively less and less Grahamian in his approach. He still remains a kind of a blend of the two, but I would say relatively he is become more of the Fisherian idea, and I would probably say to the good effect, because Graham's investing requires special conditions for you to succeed. It requires that kind of a blood on the street, and it requires so much of enormous kind of a value to be there for you to make success. And that's not a usual condition to be found. Secondly, the regulatory responses and world's capability to deal with challenges of the depression kind is far different and far more evolved. Therefore, you don't find that kind of a morbid period for long enough time. And to that extent, Grahamian situation requires very special condition for you to make a successful investment career. And that's not a usual condition to be had. But the Fisherian approach, in a general sense, is prevalent for a longer duration in one's investment career. And therefore, it is a predominant resonance in terms of how to build about your investing. Secondly, I would say the apart from relative temporariness of Grahamian situation and relatively specificity of Grahamian application of the investing, and relatively more generality and prevalence of Fisherian approach, I think there were fundamental and material differences. The price to book and the price to earning multiple, and relatively more of the former, price to book, or rather even price to working capital asset, which is the classical Grahamian approach at that point of time. Those were again product in an outcome of a very specific and not recurrent kind of a condition. It was a static snapshot of a point of time rather than generality of over a period of time. It is like a balance sheet, which is at a point of time, rather than a profit and loss account, which is over a period of time, which is what Fisher represented. That balance sheet snapshot in specificity compared to generality and over a period of time really is where the essence of difference between price earning multiple and developing a more robust approach to valuing a business really is relevant. Of price earning multiple, price to book, and price to working capital are very extremely narrow kind of ideas, but price to earning itself suffers from a lot of weaknesses. Price to earning is about price today and maybe earning 1 year or 2 years down the line, while value of business is about long term and lifetime of a business. Second, price to earning is about profits, while value of the business is about cash flows. Thirdly, price to earning is neutral or doesn't take into account the qualitative connotations of the earnings. Value of a business fundamentally is derived from the qualitative connotations of quality of growth, capital efficiency, moats, and therefore durability. Without that, it's a limited kind of an idea, the price earning multiple. Fourthly, price earning multiple doesn't take into account the time value of money, while value of the business is inconceivable without taking the time value of money. The IRR, or the fundamental cost of capital, at which will discount the future to arrive at a present value. And therefore, when you think more and more about philosophically, and there are 10, 15 more points I can make on why price to earning multiple is a popular one, but a simplistic idea, while value of business, even if it's a complex idea and more difficult to make it work, but is the only way to look at value properly. The fact that it is difficult doesn't mean we have to abandon it. And the fact that price earning multiple is simple, but we have to realize it is simplistic and not merely simple. And therefore, when you add that layer of little bit of more complexity, we realize that value can only be about the real value of a business. Price earning multiple is merely a shadow and a temporary kind of apparition, a temporary ghost, but not a reality. And finally, on that question about how to weave in the two, there are many fundamental pillars of what creates value, but I think the three most important ones are growth, the quality of the growth, and the value. And I think investing is not about one or the other, like popularly investment literature or many a times market fashions, or even many market forecasters seem to suggest today is a time for growth and tomorrow is a time for value, as if one can presciently predict these fashions as they will come. But really, good investing is amalgamation of all the three. If the business is not going to grow, stagnant waters don't create value. Therefore, growth is essential. But growth without quality of growth being right may be recipe for destruction or mediocrity. And therefore, quality of growth is also vital. You may have quality of growth and you may have growth. So you have two important conditions, but you still need to buy the package at a sensible price. And if you overpay for that package, to that extent you have surrendered the future returns to be had. And therefore you have to wait for some amount of margin of safety and a discount or a value to emerge. And finally, all of that is to be combined with the temperament and the mindset and the discipline and mental heuristics. Therefore, if you have growth but not quality, that may be recipe for disaster. You may have quality but not growth. That may be recipe for stagnation. You may have both, but you don't have value. That may be earning low returns or mediocre returns. And you need all the three in order to make meaningful, sustainable returns. And therefore, investing has to apply all of these rolled into one. We can't be servants of mechanical servants of philosophy and ideas. We have to be we have to be servants of investing, but we can't be mechanical servants of investing. We have to constantly shape and reshape and test on the empirical, on the power of that heat. The metal has to be shaped, heated, and refined. And then only we kind of separate gold from the dross. So therefore, investing will have to remain a good amalgamation of all the three, to my mind, or at least that is what I seek to do it all the time.
I think those are some fascinating insights, Bharat Bhai. And then towards the end, when you were giving those three examples, I could at least think of three different stocks that I could fit into each of those buckets in terms of value, growth, or stagnation. Uh, if I was to take you back to the last 2 decades, and you spoke about the fact that markets are designed to make you fail, and you spoke about certain unfortunate incidents in the early 90s. If I was to ask you one specific learning that you got out of three major events in the stock markets in the last 20 years, the first was obviously at the turn of the century where you had the dot-com bust. The second was the financial meltdown of 2008. And third was this vociferous fall that we saw on the Nifty from 12,500 to 7,500 during COVID. If you look at each of these three incidents in isolation, what is the one thing that each of these particular incidents has taught someone like you, and how do you apply those learnings in your investing?
Sure. Again, a very layered and very, very intelligent question, I must say. And as I said, a complex question with a lot of layers around it. All of these three incidents that you mentioned has a fascinating insight about investing. So there is individually, each incident highlights something, and all put together also collectively represent some very interesting kind of ideas and insights. First, let me deal with individual one. The dot-com era, the so-called technology boom, and the kind of euphoric rise and then a catastrophic fall. What began like a ripple from, I would say, 96, like 94 is the year, I think, or 93, maybe 94, when the romance with Infosys and Wipro for me began. And those businesses remained significant opportunities for a long period of time. Mm-hmm. But in market recognition, they still represented ripples and not waves. After, from 94 to 98 or 99, in that 5 year, I think ripples started acquiring a shape of wave. And then it became a storm. That is where it swept up everything, way too much, and well beyond one's own imagination. And therefore, I refer to my self-discipline part that in Infosys, something that I had invested probably at a double-digit cost, and we as entity owned a percentage of the equity of the firm. And we saw it going all the way to some 15,000 rupees. And yet, whether I was in a drunk shape, I was in a stupor, or I was in a spell, I don't know what, but I kept watching all through from some low double digit kind of a cost to a price of 15,000. And all through, I just kept watching and watching. Now, through that storm later on, from ripple to wave to the storm, when a tide comes or a storm comes, all the boats get lifted. And a lot of inferior and rubbish businesses got lifted. I mean, complete junk businesses, downright dishonest businesses, downright fraudulent businesses, and thoroughly thoroughbred thuggish businesses where managements represented no pretense to any kind of behavior and any kind of norms of propriety. I mean, those kind of businesses also went through stratospheric kind of rise, unthinkable, where businesses gallop by 100 times and more, kind of unimaginable. While those businesses, which were rubbish and gross, finally got obliterated to dust and were reduced to nothingness. But the good businesses like Infosys and Wipro, though they too fell and fell badly. So Wipro and Infosys both came down 50, 60, 70, 80% from the peak at one point of time, because like a recoil response, the kind of an up move was matched by equally a horrendous kind of a violence on the downside. But it is to their merit and the strength of those businesses that finally they recovered at some stage that value after a few years. Then they rose, and then they materially reasoned from where they were, from the kind of a down phase that they witnessed at that point of time. In other words, quality is something which stands the test of time. But when you flirt with inferiority, the destruction is forever. The fate of a good business and a bad business, both are predetermined. Good business may eventually will rise and achieve a higher level of a crest, and a bad business eventually will fall and reduce to nothingness. But in between, good businesses go through temporariness of falls before they rise, and bad businesses go through illusions of stratospheric rise before they ground to dust. 2008-9 was a reminder of how not to lose sight of the valuation, that you may do everything right, that you may do every single thing that may be proper, but you do not want to lose sight of the valuation. And when valuations are violently up, they become violently down itself. Therefore, up moves may represent elation and joy, but that is where the seeds of the risk are laid. Down moves may look like inundation of doom and depression, but that's where the seeds of opportunity actually are planted. And therefore, when the elation and violent up moves are there, the risk is actually the highest. And paying attention to those valuations and suitably protecting oneself as well as one can is a must. And I think that was a very, very important insight in all of this. The 2020, where in a single month you witness Nifty losing some 30 to 34, 35%. Overall market probably lost some 40 odd percent or more in a single month of March. And by the time you kind of even realize what has happened and recover some notion from the days, and before even you figure out anything, you find that markets blaze their way up and people are completely like mute spectators in terms of what has happened. Important insights, I would say, are two. It is our duty to figure out what is transient and distinguish it from permanence, and not overpay attention to transient and remain steadfastly focused on what is permanence. While what is transient and what is permanence, what is enjoying permanence is a tricky issue, and there are not easy answers to make a judgment. But investing is not about that easy part. Investing is simple, but not easy. And therefore, that judging in distinguishing from transient to permanence is an important duty on an investor, however tough and however frightening that discovery you are making while the violence is playing out. Second, an important one, we have to remain important servants of the markets. We should not attempt and overjudge what markets are and where they are headed. In other words, our energies have to be devoted to not judging markets and making too many opinions and remarks about it, but to remain focused in judging what we own and to remain critical about it. When we try to make too many judgments about markets, we attribute a level of arrogance to ourselves, which markets are always too ready to devour you as market's next victim. And to that extent, remaining sort of reverential towards markets, or at least that is what I believe is a very important idea. Reverential is not slavishness. It is not about not being critical and judgmental. It is not idol worshipping, but it is certainly and certainly to remain on the right side, to say that markets collectively represent often a kind of an insight, kind of a knowledge and wisdom which should not be dismissed away easily. And if we have to dismiss it away at any point of time, we have to be really be sure, and we have to test it too much before we come to that conclusion. And even then we have to remain so to say, a kind of we have to retain a realization that we can still be wrong and not overtreat our own understanding of it. When I combine all the three incidents that you talked about, the three major events that we witnessed, I think if I had to blend it all into a couple of insights, I would say that markets are not obvious. Markets are not very definitive. Markets are more to be perceived, to be judged. And if they were to be so apparent and so very easy to crack, then I think investing would have been relatively a simple charade, which I don't believe it is. Therefore, markets are not upfront. It requires a lot to reveal them. It requires a lot to dig out what markets are and to kind of unravel its mysteries and charms and its joys. And all of them occur together all the time. Second, that behavior of the markets is inevitable. We have to accept it as a reality. We cannot decide or lament or complain or get over elated by it. We have to realize that markets are what they are. We have to be what we have to be in order to carve out our path through the violence, through ebullience, through the machinations, through the traps, and through its, completely mercurial kind of a behavior. We have to find a path which is a greater ring of truth and greater ring of permanence, while remaining reverential to the markets without being overconfident. At the same time, remainingly adequately having belief about what we do, that end purpose of it, when done with discipline and wisdom, markets will reward you and that you will carve out your path well. Third, while intellect is necessary to make good results out of the markets over the period of time, skills are essential to make decent results out of the markets. But more than the skills and the graces, it is discipline and wisdom which have far greater role. The science of skills and the science of intellect, the left brain may look sharper and brilliant, but it is relatively, tempered mollification of the discipline and the wisdom, relatively understated character of those two attributes which have a far greater importance. Both are needed, but the role of wisdom and discipline is far higher in the final scheme of things. In terms of the proportion, it may be 50 to 48 wisdom and discipline, or 52 and 48 of intellect and skills. But in terms of the consequences, it may be 90-10. And therefore, to remain on the path, to remain and realize that we have to remain on that path, remaining worried, remaining cautious, retaining a level of doubt, at the same time retaining faith and strength about one's own understanding, about one's own knowledge, refining it, shaping it, redefining it all the time. Therefore, retaining a curious mixture of fear and worry and concerns, and strength and the solidity that faith and belief and conviction and self-confidence of a right kind that gives you. I would say the three events each has something to explain, and at the same time, they all combine together probably has this kind of three underlying traits.
Bharat, your knowledge is akin to an encyclopedia unto itself. Your personality is as vibrant as the color of the shirt that you're wearing. And as I said at the start of this, that, my mother always said that as old as you get, never lose the child inside you. Your childlike enthusiasm and your passion for your subject is still very, very evident. I can't tell you what a pleasure it's been to listen to you over the last 60 minutes. I could have gone on, and I'm glad to, have the opportunity to have access to you, and I can definitely continue this conversation offline. But I hope you enjoyed being on this broadcast. It's been an absolute pleasure listening to you. I'm sure all the participants who joined in are wiser for it. And I'm going to walk away with definitely, I'm pretty sure, with some more than one learning from the experiences that you have shared with us today. I want to really thank you on behalf of my firm for taking out time on this Friday evening to do this. And I hope you enjoyed being on.
Absolutely. I must say, every single question that you raised had a very introspective color to it, very thinking mind about it, in terms of going beyond, relatively facile aspects, but into really exploring the mind. So I enjoyed every single minute of it, answering it. So really, I must thank you for asking those questions rather than you having to thank me for answering them. Absolutely a delight to be here talking to you.
The pleasure is entirely mine. I won't take the entire credit, Bharat bhai. I think my colleague Arjun did help me do a little bit of research on you. So I'd probably give him part of the credit for digging out some of the information on you. But it's been a pleasure. And I hope to see you in person in the not too distant future as this pandemic goes behind us. Stay safe. Thank you so much once again. And to all who joined in as well. Thank you so much.
Thank you, Rahul. Much appreciated. Thank you.
Thank you.
Bye.
Thank you so much.